John Jennings, welcome to the Long-Term Investor.
I'm excited to be here. Thanks for having me, Peter.
Well, I know that you're probably only about a mile away from me. We could have maybe done this in person, but I was so excited to make sure we had the conversation about your new book, The Uncertainty Solution. And let's just dive right in. What are some of the things that we silly humans do when we're facing uncertainty?
Yeah, so first let me describe basically what it means when we're feeling uncertain. And it really means that we're having trouble recognizing a pattern. So we've evolved to be this pattern recognizing species. And when we can't recognize a pattern, we feel anxious, we feel worried, and really what we try to do is find a way to resolve the uncertainty. So in fact, the resolution of uncertainty, or you can think of it more, flip it on its head, as the quest for certainty, is a primary human motive. So even if you don't realize it, it underpins a ton of our behavior and our decision making. And some of the things that we do when faced with uncertainty that aren't really helpful or productive and can be counterproductive are things like we search for closure. So we have what's known as a need for cognitive closure. And the way this works is we want the world to make sense, and we want to have explanations. We want to see cause and effect. So what happens is when we feel uncertain is we kind of search around for the first explanation that fits our worldview. And then we say, that's the answer, because now we don't feel uncertain anymore. And that's called seizing. And then once we have seized on something, we freeze on it, meaning that we do not want to change our reasoning or our explanation, because then that will throw us back into uncertainty. So a great example was during COVID, right? So when COVID was spreading and we were all feeling incredibly uncertain, like what's going to happen? Is this going to become a pandemic? Is this more like the flu, or is this more like, the Spanish flu that, that occurred back in 1918? We all were looking for explanations, and we tended to grasp whatever was fitting our worldview or our social group, and then we wanted to stick with it. Even when the science changed or the virus changed, we didn't want to revisit our explanation for how to view what was happening with COVID. So it's a perfect example. It happens in financial markets and in all areas of life. So that's just one way that we approach uncertainty that isn't necessarily helpful.
And uncertainty is really all around us. The world is uncertain. And I think you talk about when we seek that closure with our brain, it's so uncomfortable to be uncertain, whether it is about our personal life, markets, the weather, whether your flight is going to be on time, how political events turn out, economic events, et cetera. And social media certainly makes it all the more easy to seize an idea that already fits your worldview. And I think that's really challenging for investors. And they're just constantly looking for these cause and effect links, as you mentioned. But there are some issues with trying to determine causation, don't you think?
Oh, absolutely. There's huge issues trying to determine causation. And again, as a species, we like to see patterns. And so we like to have explanations, which means we like to have causes. So if A happens and then B happens, we jump, it's human nature, we jump to A cause B. But there's all sorts of different things that could have caused B that wasn't necessarily related to A. And this really gets back to, we all have heard or been taught, if we take in statistics, that correlation isn't the same as causation. And we can all state that, but it becomes harder to apply in practice. It really does. So there's other things like sometimes A and B can have are symptoms of the same underlying cause, right? Or it could just be a spurious correlation. So A and B could be happening and it's totally separate. And in my book, I talk about a story that happened. And I was at a conference, and I ended up talking to someone, and Peter, you go to investment conferences, you know how this is. You have like this day of speakers, and then you have like this cocktail hour, and then like this dinner. So I'm drinking this like nondescript conference wine. And I'm talking to this woman and I'm like, what does your firm do? And she was the CEO of an investment firm. And she says, what we do is simple and very effective. We only invest in publicly traded companies that have strong female leadership, either number of board members, CEOs, president of the company that are females, because research has shown that female-led companies outperform non-female-led companies. And I was like, wow, that sounds amazing and really compelling. So I came back to work after the conference, and I spent like a few days digging into this when I had time. And yeah, there's all sorts of research that shows that female-led firms outperformed male-led ones. And there are different indexes of, female-led firms, and they did better than the S&P. Like over the prior 5 years when I looked at this, crushed the S&P. I was like, wow, that sounds amazing. And some of the reasons why in the research, why they guessed why female leadership caused firms outperform is, 70% of consumers' decisions are made by females, and maybe female leaders are more in touch with their fellow, females. Maybe because females are more risk adverse, maybe that's a better management style to take less risks. Maybe your firm doesn't blow up or make, bad decisions. Or maybe because there's this glass ceiling. If you are a female and you've risen to the C-suite or the board of directors of a company, you've had all these obstacles in front of you. So maybe you are more talented than your male counterparts, right? So there's all these reasons. There was others as well. And I remember I went, a few days later, and I met with one of my clients who is one of the smartest people I know. He was the CEO and president and chairman of the board of a Fortune 500 company. And I told him about this, and he said, are you sure there's a causal link there? Like, what if they're correlated, or maybe they share a common cause? And I'll tell you, like, if it weren't for how much I hold this person in high regard, I probably would have just argued back because I was pretty certain. But I went and did something that was really hard, which was fought my confirmation bias. But just because I so held this person in high regard, and I researched the opposite side. And guess what? There is some evidence and some research that says that female leadership is a symptom of a high-performing firm and not a cause. And a researcher from Northwestern, who's a female, posited this and had some reasons for this. And a psychologist looking at this said, maybe it's that once you're a high-performing firm, then you have the resources to start focusing on things like gender diversity. And at that point, you say, it's important for us to signal that we think this is important, but you're already high-performing. Now, the jury's out, so there needs to be done what's known as longitudinal studies to really tease this out. So I'm not saying that female leadership isn't superior in terms of causing a firm to be high performing. Our CEO, I'm president, our CEO is a female. We have females on our board. We are 70% female at our firm. I'm a big fan of female leadership, which is, I think, part of the reason I jumped to the conclusion that it caused it. I kind of wanted it to, given our leadership. But it was really telling when I went and looked at the other side to say, hey, maybe they have a common cause. And the point of me telling the story in response to your question is really to highlight how hard it is to determine causation. Because it does look in the situation like female leadership is causing outperformance, and then there's some explanation for it. And it's like, mic drop, done. But maybe not so much. And I'll tell you, since then, at least as of about a year and a half ago when I last looked at it, over the last 3 to 5 years, the female leadership index has actually underperformed. Again, not dispositive, but just interesting.
What a great example of something that seems to be causing another thing. And especially if you're open to that viewpoint, open to that link of cause and effect, it makes it that easier to grasp. And kudos to you for listening to what sounds like a thoughtful gentleman to make you look at the other side. And I know that, and you probably experience this too, when we're speaking with investors, a really common link that people make that you and I both know just isn't true is the economy and the stock market. Can you talk a little bit about that?
Yeah, exactly. And let me set up, kind of this correlation causation and why in my book I talk about the economy versus the stock market and why we started talking about uncertainty. So the premise of my book is that humans dislike uncertainty and we act in some counterproductive ways in the face of uncertainty. And by my book being called The Uncertainty Solution, the solution isn't that I provide certainty. I don't think I'm able to do that, but instead to say that as investors, we're better off focusing on what we can control and what we can know. So in my book, I have 35 what are known as mental models. And I've found that great investors and great decision makers in all areas of life fall back on what's known as mental models, which are just models we keep in our heads of how the world actually works. And so this stock market is not the economy, is a mental model that when you feel uncertain, that you can fall back on to make better decisions. And I think this is the most important investment-focused mental model in the book. That, and really, what the mental model says is that the stock market and the economy are not correlated. So if you look at what's happening in the economy, so for instance, if you look at GDP growth, which is a measure of how the economy is doing, for a calendar year, and then you look at what the stock market does, the correlation since World War II is 0.03. And since my birth in 1970, it's like 0.05. So it's basically zero. And when something is not correlated, when two things are uncorrelated, it means that how one is acting doesn't tell you how the other is going to act. So what that means is what's going on in the economy currently, or what we think is going to happen in the economy in the future, does not tell you what the stock market's going to do. But interestingly, there's research from Credit Suisse, and I'll tell you, like in a few years or decades, people won't know what I mean when I say Credit Suisse. Unfortunately, they were kind of subsumed by UBS, great storied firm over in Geneva. But anyway, Credit Suisse looked at it and said, hey, what would happen if we took the prior year stock market returns and compared them then to the following year economic growth? And then the correlation jumped to like 0.6, 0.65, depending on the time period. But so what this says is the economy doesn't predict the stock market because they're uncorrelated in real time, but the stock market predicts the economy-ish. Like it's not always right. And again, it's just ish in terms of direction, not in terms of how much it's going to be up or down. But it sort of makes sense. So what's happening is the stock market is anticipating what it thinks the economy is going to be doing, a few quarters or even a year ahead. And we saw a perfect example of this in 2020. So going into COVID, the stock market high was on February 26th. It fell about 34% between then and March 23rd. So what was happening on March 23rd in the real world, in the economy? So we had about our 1,000th reported death. The 1,000th death occurred 3 days later, according to reports. And if we had a crystal ball, so basically, Peter, if you and I were sitting there, we had a crystal ball, and it didn't tell us what the stock market was going to do, but it would tell us what's going to happen in the real world in the economy. And our crystal ball says, hey, guess what? Next quarter in Q2, the GDP is going to decline by 8.9% in one quarter. Unemployment is going to spike to 14.7%. Unemployment claims are going to go over 3 million. We're going to have over 300,000 U.S. COVID deaths by the end of the year and over 6 million globally over the next 3 years. International travel is going to be canceled. We can't even go to Canada. I mean, holy cow. Entire industries are going to be decimated. Pro sports teams are going to cancel and on and on. And it's not going to go on for weeks. This is going to go on for years. I think we would be like, okay, we should just put everything in, gold or under our mattress, right? But that was the stock market bottom on March 23rd. And the market, rallied by 70% by the end of the year. And that happens over and over. We saw it happen in 08, 09. And, people always say, why the stock market doesn't make any sense. The news is bad, but the stock market's good. Well, the news is good and the stock market's bad. And the reason is they are uncorrelated in real time, and the stock market is somewhat predictive of what will happen in the economy, as is, the bond market. And how you use this, you could, as an investor, go, well, that's useless. That's a useless mental model, Jennings. I am no way reading your book. That's dumb. Well, it's actually incredibly useful, because what it tells you is that you should be a disciplined investor and you should follow your strategy regardless of what the news is. And the way we use this, I'll tell you, on March 26th, so 3 days after the bottom, I wrote an article in Forbes called "Even Though a Recession is Looming, It Does Not Mean You Should Sell Out of the Stock Market," or something like that. And I made these points on the stock market is not the economy. And the way we advised our clients was, let's ignore what's going on in the real world. I mean, in terms of investing, let's go ahead and follow the strategy. Let's rebalance, let's act like the world's not going to end. And it worked out great. And I've been asked, really later that year, people said, "Oh my gosh, you called the bottom. You wrote an article saying don't sell the stock market basically 3 days after the bottom. How did you do that?" I'm like, no, you're missing the point. I didn't say the stock market was going to bottom. I said I had no idea. And nor did anybody else. And that is how we should invest. And we should remember that we don't have any idea. And that's really an incredibly important tool. And it should be freeing for investors. So you don't have to find an investment advisor that can predict the future, because good luck with that, right? And you don't have to completely keep up and read the Wall Street Journal every day and watch CNBC and, have to know exactly what's going on in the economy to invest well. In fact, kind of ignoring all that probably will help you invest better.
John, you and I have had the opportunity to speak before, and so I know some of your thoughts on this before I even ask. But one thing that strikes me about people like you and I who do a lot of reading, who are continuous learners, is that we recognize that investing can be a very complex activity. And ultimately, as you learn more and more, and even see the market through the eyes of something like a complex adaptive system, the more eloquent a very simple solution to investing can be. And some of your statements of, "Hey, we can't know where anything is going to go. You need to focus on what you can control," are really, in my opinion, driven a lot by the understanding of the concept of complex adaptive systems. Now, this is a slightly more technical concept, so let's try to keep our listeners with us here. Why don't you start us off by describing how you think of the market, or just as complex adaptive systems to start with?
Yeah. Well, I'll tell you a basic problem that economists have trying to predict the economy, or investment experts have trying to predict the stock market, is they want it to be like physics. And they have, really economists in particular have what's known as physics envy. So you read these economics papers and they're full of all these formulas as if there are these immutable, laws and rules, kind of like the, Newton's law of gravitation and motion, or that are going to happen and occur all through time. And that's just not the case. That the economy and the stock market are more like biology, where you have evolution, right? So there are definitely patterns in the stock market and economy. We do see cycles of, boom and bust and growth and decline and crashes and bubbles. Like, we absolutely see that. So there are some patterns. I don't mean to say that everything is completely random, but the amplitude, or how much, how high or low things go and when they turn and when they change, are things that cannot be consistently predicted. And a key reason why that is, you mentioned complex adaptive systems, and that's what the stock market and economy are. And really what that means is that you have a bunch of different inputs that, as they interact, can result in system-like effects that are unpredictable. And that it especially happens in complex social systems like the stock market or economy or even politics, where you have a bunch of individuals that are intelligent. And what I mean by intelligent is that they learn. So, and they're watching everybody else. So, we can't treat the stock market or the economy as some static thing that when A happens, B will always happen, because people will notice when A happens, B happens, and then they will change what they do accordingly, either to profit or avoid loss. And then that pattern becomes destroyed, or at least the ability to profit on it. And so an example of this was, again, to use COVID, which has so many different examples, is toilet paper hoarding. So the chapter you're referring to is called Why the Stock Market is Not the Economy, and What Toilet Paper Can Teach Us About Investing. So as you recall, what happened early in the pandemic, in March, is you you couldn't find toilet paper anymore. So you had these situations and these, these great pictures where people go to, Costco and Walmart and Target, and they'd load up and they have these 2 shopping carts full of toilet paper. And, who knows why toilet paper was what was being hoarded. So like, seriously, like if it was a few years ago, Peter, we were sitting here on this podcast and I said, hey, Peter, if we would happen to have a pandemic, like what would you want to buy to prepare? Right. And it's interesting. In 2017, I actually wrote, I read a blog, and I wrote a blog post in 2017 or 2018 called Pandemic Preparedness 101, and said, guess what? The CDC says at some point we'll have a pandemic, and here's what you need to do to prepare. By the way, I did none of them prior to COVID, even though I wrote a blog post on it. But like, I didn't list go buy a bunch of toilet paper. It was things like, maybe have some cash, around your house. And I said, have some masks, maybe N95 masks. So I did nail that one, even though I didn't do it. Have water, have canned foods like beans. I didn't say in the blog post, but maybe have some beer or whiskey, right? Or, now that it's legal, maybe have some cannabis, or, whatever is going to help you make it through the pandemic. But toilet paper wasn't one of them. So somehow, some way, the spark happened. And I'm not talking about the spark of life that then there's evolution. I'm talking about the spark that caused people to start hoarding toilet paper. Completely irrational or somewhat irrational. But then once it started, it became rational to buy whatever toilet paper you could get your hands on. And I did it too. In April, I went to pick up a prescription at Walgreens, and there was 1 package of toilet paper. I couldn't believe it. I bought it. And I was checking out. I tell the clerk, I'm so sorry I'm buying this because we have plenty of toilet paper at home. I'm being part of the problem, not part of the solution. And that's not how I see myself, but I'm going to buy it anyway. And she like looked at me kind of like, why don't you take your possible COVID breath and move on? Right. But like, I bought it. So my rational, I think it was completely rational to buy a package of toilet paper when one existed, but it caused this irrational system-wide effect. And so what you had is you had everybody watching everybody else. I only bought toilet paper because everybody else was buying it. And then my action and everybody else's rolled up to cause this adaptive behavior, created this system-wide effect of there being a toilet paper shortage, which created a feedback loop, which caused everybody else to even more want to buy toilet paper, right? And that is a complex adaptive system in action. And that's what happens in the stock market. I mean, we saw it with like GameStop and AMC, probably most cryptocurrencies at this point. Who knows? I mean, who knows? I mean, Dogecoin, I mean, the thing was started as a joke and Elon Musk tweaks about it and it spikes in value. And it's because people think other people will think it's worth something. That's a complex adaptive system. And it happens even in real stocks as well. Like you look and you think, oh, people think this is valuable, so other people will think it's valuable as well, or on the way down, et cetera, et cetera. So it's pretty fascinating. But what it tells you, and the main takeaway from a complex adaptive system is that it's really hard or even impossible to predict system-wide effects because it's too complex to model all the millions or billions of actors that are intelligent, that are reacting to stimuli, watching each other watch each other, and reacting to feedback loops, which means that you should be pretty skeptical of predictions of what are going to happen in complex adaptive systems.
I love the toilet paper story. I remember reading it when you first published it on your blog, then obviously again in the book. And the thing about complex adaptive systems that people really fall victim to with those predictions is that they place so much emphasis on just a few specific data points that allow for a narrative to closely link cause and effect. And complex adaptive systems, when you take all those inputs, they suddenly take on these additional characteristics that can't be accounted for by simply weighing the individual parts. And I think that's what a lot of people, when you really start to appreciate the market as a complex adaptive system, that's a really big piece. And then you can ignore predictions and you can assume that chaos will eventually occur. So it's important to have a plan in place. You can't really worry about when or why it's going to occur. I think I was first introduced to this concept by Michael Mauboussin. You make reference to what is also one of my favorite investment books, The Success Equation, in your book. And another important idea that Michael Mauboussin talks about is the skill luck continuum. So, by the way, he also writes a ton about complex adaptive systems.
He does.
For people listening to the show on any podcast platform, I actually have a couple episodes, I believe episode 70. And if you're watching on YouTube, you can go to the longterminvestor.com. But as we transition into another great big idea, the skill luck continuum, there's really two questions that can help people sort of untangle how much skill and how much luck is contributing to outcomes. Could you talk a little bit about that?
Yeah. And I'll tell you, again, this is all Michael Mauboussin. So like I quote him heavily, not just that one book, but some of his other books. He's an amazing thinker that a number of his concepts have really had a big impact on how I view the world, and I think beneficially. And the skill luck continuum says, on one side are things that the outcome is determined purely by luck. So think roulette or the lottery or slot machines. And at the other end, there are things that are determined entirely by skill, like chess, or close to all skill would be a running race. Somebody that's faster will beat somebody that's slower, swimming, things like that. And then towards the skill side is most sports, and towards the luck side is investing. And there's definitely skill in investing. I mean, no doubt, but there's a huge luck component, much more than there are in sports. And think about how much the luck there is in sports. Like, I'm a huge St. Louis Blues fan, and there's nights that we lose by one, but we hit the post 3 times. Or you watch football and the game-winning field goal, doinks off the uprights because there's a gust of wind, right? So there's definitely luck in the results of all these things. But there's 2 questions he asked that I think are so great, and to tell whether something's mostly skill or mostly luck. And the first is, can an amateur beat a pro? And so if you think about it, like, I don't play chess. So if I learned chess and then played against my nephew, who's an expert chess player, like, he'd beat me every time. Like, absolutely. Whereas, like, I'm also an amateur slot machine player because I don't play slot machines. But, if I went and played slot machines against a grizzled slot machine investor, like, it's all luck. It doesn't matter. Like, there's no such thing as a professional slot machine, investor, right? And those that think they are just seeing patterns where none exist, right? And how about investing? Can an amateur beat a pro? And all the time. And I tell the story in our book in 2020. Our top performing portfolio. So my firm, we mainly work in the $50 to $500 million range. We only work with 63 families. At the time, it was like 55 families or something, like $13 billion of assets. It's hundreds of portfolios. And our top performing portfolio was of a middle schooler named Sophie. And I forget her exact return, but she crushed the market. Like, it wasn't even close. And she had gotten, the prior year, she had gotten a gift from her grandparents of, I don't know, like $1,000 or something. And we met with her and we helped her pick the stocks. Again, it was none of us. We just explained what a stock was. And we're like, do you have any companies you like? And she's like, well, I love my iPhone. And we're like, okay, Apple. And she's like, well, I love the blah, blah, blah TV show. And we're like, okay, Netflix. And she's like, and my best friend's dad just bought a Tesla. And we're like, okay, Tesla. So those are 3 of the top 20 performing stocks in 2020. That's all she owned, right? So just absolutely crushed. Like, she would be the top 0.01% investment performer in the entire US. And she's in middle school and had just learned what a stock was half an hour before. So that tells you about, can an amateur beat a pro? And then the second question is, can you lose on purpose? So again, if I'm playing my nephew in chess, he can lose on purpose. I swim. If I swim against a former college swimmer who could definitely beat me, I'm not that great of a swimmer, they could decide to lose. Maybe I'd pick up on it, but if I race them, they could decide to lose. Whereas if I was playing, roulette, could somebody choose to lose on purpose and be sure that they were going to lose? No. Or, the lottery. You think about this, even with Powerball, how much, say it's like $100 million Powerball. How much would somebody have to pay you for you to play Powerball with the result, if your number was drawn, you would die, right? It wouldn't, maybe it's not $100 million, but maybe it is. Maybe it's $1 billion. Maybe there's no number you do, because it could happen, right? So, can you lose on purpose? But when stocks, I asked this question. I've used this question a ton, since I read the book about 10 years ago. And a lot of people say, yes, you can lose on purpose in stocks. And the answer is no, you really can't. Because if you could sell short that stock. And I will tell you, picking a stock that can go down is or sometimes even more valuable than picking one that will go up. So, and there's no famous short sellers. Like, there's no one we could point to and go, oh, they have made their career short selling stocks, because it's even harder than investing long, meaning invest in stocks that go up, because the stock market usually goes up. So to invest against it's incredibly hard. So, and I have all sorts of examples of not being able to lose on purpose with stocks, and many other types of investments. So investing is a lot closer to the luck into the continuum. And there is skill. But what it means is, and Mauboussin goes into this in his book, and I've seen this play out, is it means you need a lot more data points. So you can tell instantly whether a tennis player is good, or if a swimmer is good, or a chess player is good. It just takes a lot of more data points, maybe, many years, maybe decades, to tell whether an investment manager or a stock picker has skill.
Yeah, and usually by the time their career is over, you may finally figure that out. And I think what's really interesting is you and I interface with wildly intelligent people all the time. And just to say that luck is going to play a big role in outcomes doesn't mean these aren't brilliant people. And if anything, that's part of the problem. The other concept I know that you mentioned in the book and that Mauboussin talks about, and also very influential to me, is this paradox of skill, where as everyone is getting better, that just makes it that much more likely that luck is going to play an outcome. And I know people talk about, if you're the unexperienced poker player at the table, you're going to get taken. You're just going to get taken. Whereas if everybody's an extreme pro, then the luck of what the cards come out play a much bigger role there. And I think in general, it's one of these things where to beat the market, you either have to have better information than everybody else, which is very, very unusual because there's a lot of proprietary information out there. Everyone's dealing with lots of information. But you have to somehow have unique information or better information, or be better at interpreting the information that everybody else has. Both huge tasks that once you really start to get it.
Or the third is better third is better behavior.
No doubt about that. And I think that's where our clients are lucky. They don't have to outsmart people. They don't have to have better data, be better interpreting it. All they have to do, it's actually pretty hard to earn the market return, don't you think?
Oh, it's so hard to earn the market return. And even if you're, and that's why it makes sense to be more simple in your investing, because the more investments you have, the harder it is to have good behavior and to manage all the moving parts to even get, the market return. And it's so hard. It's so hard to be patient. And I'll tell you, like me personally, I tell this in my book, my 401k plan is at Vanguard and it's invested in 4 index funds: a bond index, a large cap domestic index, a small cap domestic index, and an international index fund. I never look at it. I can't tell you within, a wide range how much is even in there, because money just goes in and then it gets periodically rebalanced like twice a year, back to its, about 80-20 asset allocation. That's all it does. My outright account has not kept up. So when I was writing this book, I actually went back and looked at 10 years, and it's not night or day, but it's lagged. And the reason really is, I know I'm not as disciplined. I'm not as disciplined about rebalancing. And when something is, really underperforming, I'm not adding to that instead of something that's recently outperformed. I tinker more. Sometimes I like to buy thematic ETFs. Sometimes I buy individual stocks. I do that. I do some of the stuff on the fringes, but I would be better off if that was in 4 index funds than what I was doing. And I'll give you an example. I do a lot of what's known as, factor weighted indexes. So they're valued on something other than capitalization weighted. And it's so hard behaviorally. Like, I know about this stuff. I've read all the research. I believe in it. Part of my book is devoted to this. And yet it is so hard for me to stick with a factor weighted index and a factor that is out of favor for sometimes years, like years. Research has shown over long periods of time, value outperforms growth. But I would tell you, for the last 15 years, it has been really hard, except for a few little blips, to be a value investor, right? And that's, if you know all that, that's hard with your own money. But imagine how hard it is for an advisor or an investment manager. If you're, a manager that's trying to outperform the market and you believe in value, maybe, you've lost 2/3 of your firm's AUM as people that don't believe as much as you have left. And then you have to start laying off staff and nobody's making as much money. And maybe you capitulate probably about the time that it's time to be back in value, and we see that time and time again, that it's really that behavior. And so it's really, I think a big role of advisor is getting the right type of investment so the client will have good behavior, right? And then helping the client have good behavior when it's hard. That's really the two most important things an advisor can do. Because I'll tell you, I think, let's say, we were going to use active managers in our firm. And let's say that we had 10 active managers that we used in domestic and 10 in international. And let's say over the next, 15 years, every single one of them beat their benchmark. Again, against the odds. But let's say we're star pickers of active managers. I would think it would be really hard, if not maybe impossible, for more than a small percentage of our clients to outperform or even stay up with the index, investing in all outperforming managers. And the reason is the behavior, because an outperforming manager, whether it's by skill or luck, will have huge periods of underperformance in which, we're not, the client won't add, or, maybe even will fire a manager when they're down. So that's why I think it makes a lot of sense to pair the type and style of investing with the sort of behavior that makes sense, because it's really behavior that's going to be the biggest driver of returns. And I think really the actual underlying investments have a lesser effect, except to the extent to which they drive behavior. That's what we've
seen. I could not agree more. I think if you're investing on your own, I hope that you take a page from John in my book. I've blogged about it, podcasted about how I invest my own money. I'm all in one single mutual fund, 100% stocks, globally diversified. Tax efficiency is not a concern for me because there is no taxable assets at the moment. And so you are holding just a few index funds. And I experienced something similar at my first firm, where my 401k was all indexed and my Roth IRAs and my taxable investments, I tinkered. I didn't rebalance when I was supposed to. And I think if you're not going to hire an advisor, you really need to emphasize simplicity, something that you can stick with. And then for people who do hire an advisor, know that guys like John and I aren't necessarily going to outsmart the market, but we're going to intelligently design a well-diversified portfolio that meets your needs and that we can coach you through and keep a steady hand on the wheel. Because that behavior piece is really, most people don't even earn the basic market return. So very few do. And people talk about average not being good enough. And heck, if it were so easy as owning an index fund and staying the course, there would be no financial advisory businesses in the country. Obviously, people aren't able to do that. One last hint.
And then tell your advisor that you're okay with having a simple portfolio, because advisors often make much more complicated portfolios than they need to. And I think part of this is a fear that they won't get paid if what they do is simple. So Peter's idea of just being in one fund, can you imagine going to your investment advisor and they're like, okay, we're going to charge you, 1% or 0.5% a year, and we're going to put you in two funds, a bond fund and a global index fund. And you'd be like, what? I could do that myself. And you're like, well, no, I'm going to help you with, tax advice and retirement planning and education funding. And I'm going to help you with your behavior. And I'm going to answer your, I'm going to be here when the market's, really tough because it's way up or way down. Like, I'm going to be here for you and help you with your behavior. And I will pay for myself, but we're going to have two investments. Like, you would go out of business. But yet that is probably the right advice for the vast majority of people.
John, it is a pleasure, as always, speaking to you. Before we sign off, where can people find you and learn more about you?
So I have a website creatively titled johnmjennings.com. johnmjennings.com. So you can find out more about me or my book. And then I have something called The Interesting Fact of the Day. It's a blog that I publish about twice a week, just on things that are interesting, well, hopefully people find are interesting. So you can find it in the menu, the IFOD for interesting fact of the day. I would love to have more subscribers. My most recent blog post was on how often do passengers die on plane flights? So
I get your email each time. I find it to be interesting. It's usually the most interesting fact I learn every day. I'll be sure to link to those in the show notes at thelongterminvestor.com. If you are listening to us on podcasts, whether it's Apple, Spotify, Google, please like, review, give feedback. That's all really helpful to delivering you guys good information. Same with YouTube. Like and subscribe. You know the drill. Leave us some comments. John, again, thank you so much for joining us today.
Yeah. Thanks, Peter, for having me.